Most business owners build their structure the way most houses get built, without an architect, one room added whenever it seemed necessary. An LLC here, an account there, no overall plan. That's how you end up personally exposed to liabilities a proper structure would have contained. Today I'm walking through the 6-step framework for structuring a business or investment portfolio the right way, from mapping what you actually have, all the way through keeping the structure alive over time. Step 1 is deceptively simple: figure out what actually exists. List every distinct business activity you run, and rate its liability profile. Is it client-facing? Product-based? Does it employ a lot of people? Is it regulated? Does it carry big contract obligations? The riskier the activity, the more it needs to be walled off. Then list every significant asset: real estate, IP, equipment, investment accounts, goodwill, ownership interests, and note exactly where each one currently sits. A lot of owners assume they know this. Fewer actually do, especially once a business has grown organically instead of by design. Step 2, decide what you actually want the structure to do. Common objectives include containing liability, keeping ownership private where that's legally allowed, syncing the structure with your estate plan, setting up governance that reflects real intentions about control, and staying tax efficient without adding needless complexity. Here's the part people skip: these objectives trade off against each other. Maximum asset protection isn't always the most tax-efficient path. Maximum simplicity might not give a risky business the separation it actually needs. The goal isn't to chase every objective at once, it's to know which ones are primary for you, and design around that. Step 3 is where the actual entities get chosen. LLCs are the workhorse: flexible governance, pass-through taxation, and in many states, charging order protection. Corporations make sense when outside investors are coming in, when you're using stock options for compensation, or when an S-corp election fits. Limited partnerships show up in family wealth transfers and real estate. And trusts do things entities simply can't, providing for beneficiaries, avoiding probate, and in some structures, adding another layer of protection. State selection matters more than most people think. Delaware, Nevada, Wyoming, South Dakota, these come up for specific legal reasons. But forming an entity in one state doesn't exempt it from the laws of the states where it actually does business. A Delaware LLC operating in California still answers to California's rules. Step 4 is easy to underrate: governance. The entity framework says who exists. Governance says who actually makes decisions, on what terms, and how disputes get resolved. This lives in the operating agreements, trustee provisions, and succession documents, and it needs the same level of care as the entity design itself. If you're using trusts, trustee selection and trustee succession are top-tier decisions. If you've got an LLC with multiple members, the operating agreement's handling of major decisions, deadlock, and member exit is critical. Get the entities right and the governance vague, and you'll end up with disputes that undercut the whole structure. Step 5 is where good structures often quietly fail: implementation. This means properly capitalizing each entity, opening separate accounts, actually executing and performing intercompany agreements at fair terms, keeping separate governance records, staying in good standing in every state involved, and consistently treating each entity as a real, separate legal person, not just paper. This is the step people skip. The entities get formed, the documents get signed, and then everyone goes back to operating informally, mixing funds, skipping documentation, treating the whole thing like paperwork instead of an operating framework. Courts look at substance over form. A structure without substance gets treated like it doesn't exist. Step 6, your structure isn't a one-time project. Revenue growth, new business lines, ownership changes, marriage, divorce, kids, changes in the law, expansion into new states, all of these are triggers to revisit the structure. And even without a specific trigger, a periodic review every few years is worth doing for anything of meaningful complexity. The cost of that review is consistently smaller than the cost of letting structural problems sit unaddressed. One last piece: structuring sits at the intersection of legal, tax, and operational considerations, and they're interconnected. A legally sound structure still needs a tax review. A tax-efficient structure still needs legal integrity. An operationally convenient setup still needs to preserve the formalities that make it work. The best outcomes come from advisors who understand all three dimensions and actually talk to each other, not a lawyer, a tax advisor, and an accountant each working in isolation, producing a structure that looks right on paper but doesn't function as intended. Structuring well isn't about complexity for its own sake, it's about mapping what you have, deciding what you actually want, designing entities and governance to match, implementing with real substance, and revisiting it as things change. If this was useful, subscribe for more breakdowns on business and asset structuring, and let me know in the comments which step you want covered in more depth.